Hi everyone, my fearless compounders. Welcome back to the channel. I know it doesn't seem like a day has passed because it hasn't. Rupesh actually has something happening in his personal life, so he wanted me to stamp out two videos back to back. So I obliged. I told him yes, I will do it. So the video which I did want to talk about, I wanted to spend more time deep diving in, which had been a much longer video, maybe 30 minutes. I've chopped it up and made it smaller as a sampler, giving you a lot of space for you to research, for you to figure out and see if there's opportunity and value in what I'm talking about. I'm talking about Big Pharma, and I'm going to talk about the Midcap Biotechs which are there in the US and lay out my case why this is a sector, though there's tariffs and all other things which are there. If you see carefully, there's deep value found in some of these companies, and maybe you can look at researching a little more and finding nuggets of gold in the coal. That said, I want to say that it's one of the most misunderstood, undervalued corners of the American stock market. And names like Merck, Pfizer, Bristol Myers, these are just not old school dividend plays. These are cash cows with strong pipelines, with some of them trading at PE ratios you would associate with cement stocks in India and not in healthcare giants. So today, if you look at it, I'm going to go through the moat, the math, the margin of safety these companies have, and the pharma picks, few mid-cap biotechs I want to touch upon, then quietly round it all up with my views on the whole lot. First is the context, industrial context, so you understand where it is. We have an aging population in the US with a secular demand for chronic disease and management. There's a constant innovation in cancer and immunology and rare diseases. Of course, there's a regulatory risk. Regulatory risks are always there in any industry, but in pharma, it is quite high, which works in both ways as a double-edged sword. That means if you're already an established player, it creates a moat for you, these regulations, because any new player who wants to enter this market has a very high barrier to jump over to get inside the market space, so it works both ways. And of course, after the COVID price deflation in these companies, some of these companies' valuations are growing, especially if you take into consideration the drugs they have in their pipeline. Pharma has always been a long game. Why is pharma a long game? Because you have to take a lot of your money, pour it into R&D, and wait for years and years of research. Then boom, you get this new drug coming out, FDA approval happens, and then you have a stream of revenue. Your cash cow, ka-ching. So the story of Keytruda, Dupixent, and Eliquis are all about the same. They're all owned by some of these pharmas which I'm discussing right now. And a lot of these giants are currently out of favor. After the COVID windfall, all of them seem to have enjoyed. Some of them have their patents expiring. So what's happening is, though the fundamentals are very solid, the valuations of these companies are quite depressed. And this, as we are, the fearless compounders, the value investors that we are, we find these opportunities and we try to see if we can enter them at the right price. Because the company may be great, might be old, but is the price right is the question. So let's deep dive into the big pharma stocks first. Of course, the first one is Merck. Merck was what I spoke about in the last video from one of the comments one of our viewers in the tribe had. And of course, the PE is 15x, dividend is 2.5 with a very stable earning. Keytruda alone brings around $25 billion and it dominates the immuno-oncology, is of course the cancer drug. It has a very strong vaccine portfolio and has recently had Winavir approved for the pulmonary fibrosis, which is another cancer. It's a long-term concern for Keytruda is, of course, it loses its patent or exclusivity. So one of the concerns is Keytruda, one of their cash cows, loses its exclusivity in 2028. Merck is always considered to have a very classic moat in pharma. If you look, Keytruda is the iPhone of cancer drugs. It has over 30 cancer indications it treats, and they've started co-developing with Moderna to develop an mRNA vaccine for cancer. And if you believe oncology, then you'd of course believe in the growth story of Merck, and it's quietly leading the charge. Merck, out of all the big pharmas I'm talking about, is not cheap in terms of cheap valuations, but the company and its cash flow should definitely be taken into consideration with its track record. So I do believe it's in fair value. And if you're looking at it in the long run, it looks rather strong. The next company in the barn house is Pfizer. Pfizer I did a separate video on, but here we should touch upon Pfizer again. Its PE is 11x, yield is 6. Post-COVID slump has happened because of the sales of vaccine have collapsed. It has a strong pipeline of 19 expected new product launches by the 2025, and it's acquired a whole bunch of companies. One of them is Seagen, which is in oncology, for $43 billion. And cost restructuring is currently underway in Pfizer, which I spoke about in great detail in the Pfizer video. If you want more information on that, you can rewind and see that. But it's a punching bag right now in the market, and market doesn't seem to be liking Pfizer too much, and they've been dumping the stock, and this is why it is at this PE. There's an argument being made that Pfizer has lost its magic charm. If you saw the way it had to withdraw from the weight loss race, and everyone seems to be trashing it. But if you see, they've taken their cash, which they made in the COVID vaccine, the cash which came in raining, they bought Seagen, and they bought Global Blood Therapeutics, Arena Pharma. All of these are going to help them boost their pipeline, and revenues, though have dropped and come down. I think this has been priced in where Pfizer is concerned as in terms of price. And if you consider the future pipeline of Pfizer and the 6% dividend, this is a patient game. I can see Pfizer being a high-yielding bond, and the upside even being 3 out of those 19 drugs, if it clicks, can take Pfizer into a new realm. I don't know. Do you agree? Do you not? Do you work in the pharma sector? Do you know about these drugs? Do you think this is viable, what I'm saying? Comments. Want to hear it. Bristol Myers Squibb. Their PE is 7x, yield is 5.5. They have something known as Revlimid off patent, which is a big drag for the company. Opdivo, which is an immuno-oncology. Eliquis, which is a blood thinner, are very strong in terms of sale. Right? They've raised their dividends consistently over the last 15 years, and they've come out with a $4 billion share buyback, which has been announced recently. So it is in a deep value if you look at it in the entire big pharma space. BMY, they don't get enough credit for their strong pipeline. I do agree on this. Even though they're launching drugs for lupus, multiple myeloma, and blood cancer, Revlimid is going off patent, and that is hurting them a lot. But what you guys do not know is how capital efficient they are, and they're raising dividends and the stock buyback, cutting cost. This is a classic German move for a German company, which is being unloved and underpriced. But I think it is something worth deep diving into. Now we spoke about Big Pharma. Let's pivot and move into Midcap Biotechs. There, I would say Regeneron is the company which you should be looking at. Dupixent, which is over $10 billion in terms of sales, treats asthma and eczema. They've also got an eye drug, which is called Elia, which is being run by the competition, but is still dominating. But they've got deep pipelines in cancer, inflammation, and new antibiotics. So if you're looking for a big biotech company in the mid-cap space, which is considered like a cash cow, like a big pharma, at the same time as agility of a small cap, I think this is an excellent mix. Regeneron, with its Dupixent, is a monster drug, and it's not cheap in terms of PE, but in PEG ratio, I think it's quite reasonable. Then we have Incyte Corporation. Incyte is a very small version of Bristol Myers. They're 10 years old, and they've been quietly getting approvals done by the FDA. They got a very good cash flow, and they don't have debt, which is a big plus. But you won't be hearing this company being mentioned in CNBC, and that's okay. These kind of stealthy stories are something which me and you as value investors can definitely be fearless about in compounding if the numbers are right and the ducks line up. So I would suggest Incyte is something you should be definitely researching and deep diving. And whatever your opinions are, I'd love to hear it, like I said. Then Exelixis, focused on kidney and liver, thyroid cancers, has a massive optionality on trials in progress, and it's sitting on $2 billion cash with no debt. So this is a purely biotech company, and it's volatile, but there's no debt in this, and it has tons of cash. So it can be a swing to the fences if you look at it in terms of the rest of them. So this is not something which I would say you should definitely buy, but it's definitely worth researching into. And depending on where you are in your runway length, and where you are in your investment strategies and risk appetite, maybe this is a company which should be there for you. But do realize there are some key things to keep in mind when you look at this as a value investor. The pharma, like I said, it's a business which is overlooked sector in the US. I love the business. Moats are great, but you have to make sure you understand what pharma business is. A lot of us fail to do this, understand what pharma is. And tomorrow I'll talk about a company which is related to NATCO. And I've done many videos on NATCO. It's not a video on NATCO, but it's related to NATCO in a very weird way. And you'll understand what it's all about if you catch it tomorrow. It's a company, and you'll understand why. You should understand what cyclical drug cycles are and not macro cycles. Macro cycles are different. Pharma cycles are different. So there's a huge difference. And pharmaceutical companies, like I said in the beginning of the video, it's all about patience, being thorough, and making sure you're buying it not at the peak. That's the kind of mindset you should have when you look at pharmaceutical companies. And that is why we find it very weird to say these medicine names, but it's important to understand the medicine names, because what drugs are they and what are they treating and what is the prospect for these drugs is very important to understand. More than the pronunciation of these drugs, what is important to understand the implications in terms of the earnings of these drugs is what you should focus on. And the amount of money they're spending on R&D and the FDA approvals they have in the pipeline, that also is something you should really keep an eye on. As I said, there's an extra video I had to do for Rupesh, so it was a bit of a rush. I really did want to deep dive into each one separately. Maybe I'll do that another time, another day. Watch out for tomorrow's video, something related to NATCO, and you might find that interesting too. It's been wonderful having you here this evening. I hope you enjoyed the video, and I will definitely consolidate the comments of both the videos and come back with my feedback and rebuttals in the next one. Thank you for watching the video, and good evening.